NVIDIA crossed $5.2 trillion on Monday. That number took a moment to land. $5.2 trillion, a new all-time high, the largest market cap any company has ever held. The S&P 500 and Nasdaq set fresh records in the same session, pushed higher by a semiconductor rally that had been slow to include the sector's biggest name. For most of 2026, NVIDIA had gained just 12% year-to-date, while its peers ran. Then Monday happened, a 4% surge, a breakout above the prior 52-week peak of $212.17, and a market cap that rewrote the record books. But underneath that headline number, something older and stranger was drawing more attention. The New York Times published an investigation on Friday, and by Monday the market was quietly doing the math. SpaceX, already carrying a private valuation near $350 billion, already the subject of a planned IPO targeting $1.75 trillion, had for years been operating as a financial backstop for Elon Musk's other ventures. The report documented 3 loans totaling $500 million, pulled by Musk from SpaceX between 2018 and 2020, at interest rates ranging from under 1% to nearly 3%. The federal prime rate sat closer to 5% for most of that period. The Musk trial began the same day. Jury selection opened in Oakland for his lawsuit against OpenAI and Sam Altman. Alphabet was trading ahead of earnings. Amazon was 2 days from its own Q1 report. The S&P 500 was at a high. It was the kind of session where good news compounds and investors stop asking hard questions. And yet the harder question, the one embedded in 6 weeks of IPO runway, was already in print. The 2002 Sarbanes-Oxley Act explicitly prohibits public companies from extending personal loans to senior executives. It was passed after Enron, after WorldCom, after the kind of insider self-dealing that cost ordinary investors everything. SpaceX could do what Enron's board could not, because SpaceX is private. That legal distinction has protected Musk's arrangements for years. Between 2018 and 2020, the loans were structurally unremarkable inside a private company. SpaceX lent Tesla $20 million during the 2008 liquidity crisis. It injected $255 million into SolarCity in 2015, when that debt carried default risk. Most recently, SpaceX absorbed xAI, Musk's cash-burning artificial intelligence lab, into its corporate structure. Each transaction moved capital from SpaceX's balance sheet into ventures that either competed with or depended on Musk's other businesses. None of this was illegal. That is the precise point where the calculus changes. SpaceX is targeting a $1.75 trillion valuation and is reportedly considering raising around $75 billion in its IPO, the largest public offering in history. Once it crosses that threshold, the Sarbanes-Oxley clock starts. The loans, the related party transactions, the absorption of xAI, all of it becomes part of the public company's disclosure record. Investors who buy SpaceX at $1.75 trillion will own a company whose financial history includes lending its founder $500 million at below prime rates. Tesla, which also received preferential capital during a critical period, will have a documented creditor relationship with the company on its S1. That relationship is not hidden, but it has not yet been priced. Here is where the logic gets complicated. SpaceX's underlying business, Starlink, Falcon 9, Starship, generates real cash and holds genuine strategic value. The rocket company is not SolarCity. The loans did not hollow it out. And yet the valuation multiple at $1.75 trillion is pricing in a governance premium that the NYT investigation directly challenges. Institutional buyers preparing for the IPO now have to weigh whether the discount for concentrated founder control is adequate, and whether the xAI integration changes the risk calculus for a company being valued as a pure-play aerospace and satellite business. There is also a second layer. Tesla is currently preparing a $2 billion acquisition of an unnamed AI hardware company, with CapEx guidance raised to more than $25 billion for 2026. If SpaceX and Tesla remain financially entangled through the IPO process, even informally through Musk's capital allocation decisions, the governance exposure for both public vehicles grows. Investors holding Tesla today already own that entanglement. Investors buying SpaceX at IPO would be adding to it.
The timing is not incidental. NVIDIA's $5.2 trillion market cap and SpaceX's $1.75 trillion IPO target share a common origin: the same AI infrastructure build-out that drove data center revenue to $193.7 billion for NVIDIA in fiscal year 2026. Starlink's enterprise and government contracts, xAI's compute requirements, the GPU density inside every hyperscaler's data center, these numbers are connected. The rally that carried the market to new highs on Monday is the same rally that makes a $1.75 trillion SpaceX valuation plausible. That is the condition under which everything holds. If AI capital expenditure continues at its current pace, Alphabet committed $175 billion, Amazon is investing up to $25 billion in Anthropic alone, then the addressable market for SpaceX's satellite connectivity and launch infrastructure remains enormous. The governance questions embedded in the NYT report become manageable footnotes in a growth story. Institutional buyers price in a founder discount and move on. The condition under which it does not hold is less dramatic but more durable. Gold fell 11% in a single March week, even as US and Israeli strikes hit Iran. The safe haven trade that every investor expected to win simply did not work. That pattern, consensus positioning that fails to perform under the exact conditions it was built for, is the nearest historical analog. The SpaceX IPO is, right now, a consensus trade, the largest, most anticipated public offering in history, arriving in the middle of a record-high market, backed by the world's most famous entrepreneur. The NYT investigation is the first systematic documentation of the conditions under which that consensus could be tested. The evidence as of Monday leans towards the IPO proceeding and pricing well. The business is real, the backlog is real, and the AI infrastructure tailwind is not slowing. But that lean holds only if the S1 disclosure process does not surface material underprice in the xAI absorption or additional related party transactions that the NYT investigation did not fully document. The verification benchmark is the S1 itself, expected within the next 6 weeks. If the related party disclosures are narrow and the xAI deal is valued at arm's length, the governance discount stays manageable. If the S1 reveals additional entanglements, the $1.75 trillion target becomes the number that reprices everything priced above it. The market hit new highs on Monday. 6 weeks from now, it will know whether the world's largest IPO was priced for the business or for the story.